Hi, everyone. I'm David Allen. I'm the Pro Vice Chancellor and the Executive Dean of the University of Exeter Business School. My job is to welcome you here. This is the inaugural MSc in Financial Analysis and Fund Management, affectionately known as FAFM, right? Alumni and Supporters Conference. And we're going to bring together people from academia, research, our alumni, of course, and industry experts to talk to you. I gather we have about nearly 100 people registered for the event. I want to say a little bit about it, FAFM. FAFM has been what we call a flagship program for us. Had set a very high entry standard. We've had wonderful management led by Jane, as you all know very well. We are in the Financial Times top 100. We're now 51st in the world and moving up. We have a very large community of FAFM graduates around the world. I'll let Jane give details later, but we think this is a great program because our graduates integrate really quickly into the finance community and get really good jobs. I want to give a special thank you and welcome to our alumni and supporters for their continued support for the program. And I want to say something briefly about the business school's positioning in the finance sector. In addition to this and this flagship program, we also run an applied finance degree apprenticeship in the finance sector for JP Morgan, the Bank of England, Goldman Sachs, UBS, and a whole bunch of others. I'm sure I've left them out. And we also run a senior leader MBA program for them as well. We're probably the leading provider of degree training at this point for the finance sector in the UK, and obviously they're mostly based in London, although based other places. This is to me a fairly extraordinary achievement for a business school that's in Exeter. We do have a London office. A lot of it does the finance work, but we really do have a strong position in the finance industry, and a lot of it is thanks to this great program. But this great program also benefits from that positioning. So I'm really proud of what Jane and the team have been able to achieve over the last few years, and I'm just thrilled that we're having this first inaugural conference. On my clock, I've officially run out of time to talk. They only give me 5 minutes, and I'm going to pass over to Jane to get everything started. I just want to thank our speakers for today, Graham Bishop, Ben Matthews, and Suresh Mistry. I hope I pronounced all their names correctly, right? For coming to join us. We really appreciate that you're here. It's great for all of us to hear from you, what you do, how things are going, how you see the future, right? In this really quite unusual time. So Jane, I'm going to pass over to you. Thank you very much, everyone, for attending, and I hope you have a great session today. Thanks very much.
Thank you. Thanks very much, David. Hello, everyone. It's my great pleasure to welcome you to our first annual MSc FAFM conference at the University of Exeter. The MSc FAFM is one of the three flagship programs in the business school, as David mentioned earlier. So it's a specialized, advanced program in finance that is geared towards investment analysis and portfolio management, and is designed for students looking to work in investment banking or asset management firms. The program has many distinguished features, including its association with the CFA Institute, a dedicated career module, a week-long international study trip, and further study abroad options, and also an industry-focused dissertation. One of the most unique features for this program is our commitment to combine academic study with practice. So we invite many prominent asset managers to come and talk to our students about the challenges faced when managing portfolios in the real world. So as a result, as mentioned in David's welcome speech, that the MSc FAFM has been ranked among the very best finance master's programs globally by the QS and also active ranking groups. So to continue to build upon our success, we thought it would be a great idea to run an annual conference associated with this program. So the objective of the conference is to bring together our industry partners, alumni, and our own academics and the students to showcase their research and to exchange and develop ideas with the aim of strengthening the relationship between industry and academia. So we aim to run this conference on an annual basis, focusing on a different theme each year. So in this very first conference, the theme is ESG and the sustainable finance, which is of increasing concern to investors, practitioners, and academics alike. Here at the Exeter, we have leading researchers in this area in the newly formed Exeter Sustainable Finance Center. My colleagues from the center will present their findings later on in the conference in day 3. Okay, so the conference is scheduled to run over 3 days. Today, we will hear from some of our industry partners. So it's my great pleasure to introduce you to our distinguished guests, Graham Bishop, Chief Investment Officer from Handelsbanken Wealth Asset Management, Ben Matthews, co-founder from Handelsbanken Wealth and Asset Management, and Suresh Mistry, co-founder and sales director from Alquity, to share their thoughts and the discovery in field of sustainable and ESG investing. So now I will hand over to Graham Bishop.
Thank you, Jane. And good morning, everyone. It's an absolute privilege to be invited to introduce the 2 other speakers and make a few remarks myself. Before I get started, if anyone's wondering why there's 3 clocks behind me, it's because it's my tribute to Only Fools and Horses. So one's Paris, one's Peckham, and one is New York. I thought I'd start, though, by making or answering 5 questions. The first is, who am I and why am I speaking to you? Well, like you've heard already, my name's Graham Bishop, and I am the CIO at Handelsbanken Wealth and Asset Management. I also wear 2 other hats that you may be interested in learning about. The other one is that I am a fund manager. So coincidentally, I run with Ben, who you'll hear from in a second, our flagship fund, which is the Balanced Multi-Asset Strategy. In addition to that, I'm also, the other hat I wear is I'm head of strategy. So funnily enough, that was the job I was originally hired to do. So in effect, taking a pivotal role in setting the asset allocation across the whole product suite. The second question I thought I'd try and answer is, why am I here? Why are you listening to me? Well, I used to attend the University of Exeter many moons ago. I studied economics, graduating in 2000. And like you heard just a second ago from Jane, that I've been helping her and Jess out an awful lot more recently with their program, which I think is an absolute triumph. And I hope very much to be down in that part of the world to do more of this in the not too distant future. I guess the other part of the reason why I'm kind of doing this today is because I think it's important to spread the word about not just ESG investing, but how that fits into the marketplace, what clients are thinking, what are they saying, and I'll come back to that in a minute. but it's also to make the very crucial point that we've all got lots of questions. And just because we are on this metaphorical side of the table does not mean we have all the answers. This is a world full of uncertainty, and we have just as many questions as you. So I do believe that by talking and collaborating, we can try and get some answers. The third question I thought I'd try and answer just now, before I hand over to Ben, is who is Handelsbanken Wealth and Asset Management? Well, for those of you who don't know, we were previously called Hartwood, and we were acquired by Handelsbanken, a big Swedish bank who I'm sure you've heard of, in 2013. As of today, our bit of our asset management unit runs about £4 billion worth of assets across a whole multitude of different asset classes. Quite crucially, we are very much top-down investors. We are global and we are multi-asset, and we provide solutions. We actually run about 11 funds, 4 of which are ESG, or what we call them sustainable funds. Ben will talk to you about that product suite, but just so you know, that kind of mirrors a core set of funds, which increasingly are not looking very core, because the ESG universe is taking over with a vengeance, and quite correctly so. So just speaking about that, the fourth question I was going to try and answer is, how does ESG fit in with what we're doing? Well, we did launch these sustainable funds 3 years ago. When I say we, I really mean Ben. Ben should take most of the credit for this. He has been pioneering this area within Handelsbanken Wealth and Asset Management for most of that time, and still is very much at the forefront of pushing those products. I would say, though, that we are quite unique, I think, in what we are offering, in the sense that we have a broad range of ESG or sustainable products across the risk spectrum. So if you walk into our office or Skype nowadays, and you have a very low risk tolerance, then we have a product for you in that space. If you have a higher risk tolerance, then we have a product for you in that space. Most organizations you go to who have an ESG offering will cater to one or the other of those ends of the spectrum. But we offer kind of a total return, ESG centric, multi-asset approach across the whole range, which I think is quite crucial. And I dare say other people will do this in due course, but for the here and now, this is somewhat unique. I should make it clear that in thinking about what to invest in, we are kind of passive, active agnostic. And the reason I reference that is because we do use passive vehicles in our solutions, in our products, but we also make use of active products, like you'll hear from in a minute. Suresh from Alquity is one of those kind of set of experts and specialists in their field who we rely on to provide us with a high quality product in different parts of the world in specific asset classes. So we do have lots of those. So it's an absolute pleasure that Suresh is here today to talk to us all about how they go about their day jobs. So if there's one way of considering how we might differ in our approaches to ESG investing, Handelsbanken Wealth and Asset Management, as Ben will describe shortly, we are looking at it from the top down, whereas Alquity, for example, will be looking at it more from the bottom up, but I won't kind of tread on toes there. The final question I would just like to kind of pose and try and answer is, what are clients saying with regards to ESG or sustainable investing? Well, the short answer is a lot. They are extremely interested, and that is in really where all the action is right now. The flow we've been seeing into our funds has been dominated by the sustainable fund range, and they are growing at a one hell of a clip. There are lots of cynics out there, and I'm pleased to say that every day there is one less cynic as soon as they start to hear from Ben and others in the team. Not least because they put up a lot of myths about why sustainable or ESG investing is inferior, or what are the problems? Well, actually, a lot of these myths can be busted very easily, and I'm pleased to say that Ben is going to start doing this very shortly. So I'll close my trap and hand over to Ben.
Thanks, Graham. Good morning, everyone. Thank you, David and Jane as well, for that very kind introduction. Very happy to be here, and thank you for having us. So in terms of a quick introduction to myself, I joined Handelsbanken in 2012 from Durham University. Apologies for that. I actually studied history, so that makes me one of a dying breed of humanities grads, paving a way through the finance industry. I've in terms of hats, so Graham mentioned he had a number of hats. My hats will be focused on, firstly, supporting Graham with the management of our flagship balance strategy, so our medium risk multi-asset fund. And then on the research side, I'm focused on the equity side of things as an asset class, but then also more and more on sustainability. And then also, as Graham mentioned, I led the launch of our sustainable strategies back in 2016, and continue to co-manage those funds alongside my colleague, Matthew Toms. So in terms of what I'd like to present today, I'm looking to just run through our journey and our approach. So sustainable investing is very much a process of improvement. There is no universal approach, so we've been sort of finding our way and developing our strategies over time. Also, a multi-asset approach to sustainable investing is relatively new. We'll hear from Suresh later about ESG investing within equity and credit markets. And actually, that's something that is quite established, but actually taking a top-down approach and a multi-asset approach to sustainable investing is relatively new. So something we've been sort of finding our way with slowly. I'll then, as Graham mentioned, talk through a few of the misperceptions in the market, and then talk about some of the holdings that we think might be of interest, and may spark a few questions for the Q&A afterwards. So in terms of our sustainable journey, as I mentioned, it started 6 years ago. The strategies were launched 5 years ago. And what we could see at that time was that a number of institutional mandates were shifting towards a sustainable approach. And the asset management industry was reacting to that in order to provide investable options for those clients. And then from the bottom up, our own client base, not just young investors, but also some of our ultra high net worth investors, we were seeing a shift in sentiment, and they were starting to ask us whether we might be able to provide something when it comes to a sustainable investment option. At the outset, the key factors for us were that we wanted to replicate our core approach, so a top-down focused multi-asset approach, without I'll get onto the slides in a second. Without compromising on key principles of performance, risk, and cost. And then finally, we wanted to have tangible positive impact. And as Graham mentioned, we've now got around 10% of our assets being run in these sustainable funds. So it's definitely a growing area for us. So Josh, could you please go to the first slide? Will it come up? Thanks very much. And yeah, next slide, please. So you don't have to look very far to see sort of societal shifts when it comes to consumer behavior as well as consumer preferences. And you can see in a number of industries, such as electric vehicles, there is a rapid shift occurring. So we've seen battery costs come down 89% over the last decade, and that's driving a rapid electrification of society, with 20% of new vehicle sales expected to be electric by 2025, jumping to 50% by 2030. So we're all sort of seeing this shift in society, and it seems to be accelerating. And the essence of sustainable investing is incorporating your personal values into not only your day-to-day behaviors or your consumption decisions, but also your investment portfolio. So that's going to be the key driver when it comes to the sustainable investment movement. Next slide, please. I don't come across many climate skeptics anymore, and so I won't dwell too long on this slide, but for me, this is one of the most powerful slides I've seen in terms of evidence of climate change and the challenges that we're potentially going to face over the next few decades. This is a chart going back 800,000 years. It's created, the data is readily available on the US government website, and it is created using a method called paleoclimatology, where you are measuring the level of carbon in the ice sheets, and then you can track what that means for the climate, the level of carbon in the climate over time. And you can see that it fluctuates quite dramatically. This is showing you a period where we had periods of extreme heat and including ice age. But the scary thing about this chart is where we are currently, and that's in the top right-hand side of the charts. So we've seen a massive spike of carbon in the atmosphere. And when I first saw this presented, it was presented alongside a chart showing you the temperature of the Earth through time, and it has an almost perfect correlation with a slight delay. So scientists are calling this humanity's first good forecast, but we are clearly going to face challenges over the next few decades. And this is both going to create challenges, but also a huge number of investment opportunities as the private sector looks to support this transition to a more sustainable society. Next slide, please. So for us, our primary goal is to help our clients achieve their long-term investment targets. And for most of our clients, that means beating inflation at a given level, depending on the level of risk that client is able to take. So our primary goal for these strategies is exactly the same as our core range. We're looking to beat inflation over the long term, and the level of outperformance is based on the level of risk a client is willing to take. But the two other sort of mission statements for these strategies are unique to our sustainable range, and that's firstly looking to incentivize better corporate and government behavior, and that's very much focused on the ESG integration side of the portfolios, and I'll leave Suresh, who is the expert on this space, to focus more on that. And then thirdly, we are looking to invest in areas of the market that are impact in nature, so aligned with the UN Sustainable Development Goals. And I'll talk about a few examples on that front in a moment. So next slide, please, Josh. So in terms of how we view the sustainable space, this is a very simplistic view of the space. We break it down into three columns. So you have your exclusions. This is your traditional ethical investing, where you're looking to exclude certain areas of the market that are deemed harmful to society. And then the second pillar is your ESG integration, where you're looking to analyze the environmental impact of a company or government, how that entity interacts within society, and then the corporate governance that is managing that entity. And then thirdly, the impact, where you're looking to invest in areas of the market that are explicitly aligned with certain goals that are deemed to be a benefit to society. So this is leading you to areas such as renewable infrastructure, social housing, or early stage life sciences. So, and in terms of the approach, there is a broad spectrum out there. So you have to be very clear with your clients about what you're looking to achieve and how far you are along this spectrum. So for us, we see exclusions as having a place, but it's not where we want to focus our energies, because what you hold in your portfolio is far more important than what you exclude. So for us, we're looking to focus on that ESG integration, which makes up around 2/3 of our portfolios at the moment. And then also look to invest in impact areas of the market, roughly 1/3 at the moment, but we are looking to maximize that exposure without compromising on the overall risk profile of the portfolios. Next slide, please. So this is showing you the breakdown of our balance fund. So this is our medium risk multi-asset strategy, looking to achieve a return of 3% over inflation over the long term. And I've broken it down here by asset class and picked out a few of the UN Sustainable Development Goals that we're looking to align with within these investments. I think it's important to state that we're not actually targeting these goals explicitly, any particular goals explicitly, but we want a broad range, and we want to have a spread in terms of areas of the market that we're investing in. So within equities, we have a number of, so our impact exposure is very thematic in nature. So again, its primary goal is going to be returns, but it does have this secondary goal of having a tangible positive impact. And we have investments in areas such as circular economies, smart and next generation materials, water infrastructure, healthcare and sustainable technology. And these are all aligned with a number of the UN Sustainable Development Goals, but at the same time are providing fantastic growth opportunities and have been the engine room of our portfolios over the last few years. Within fixed income, the focus is more in areas such as green bonds and social bonds. So bonds that are issued to raise money for ring-fence projects that are either environmentally friendly or deemed to be supportive of society. So that could be a corporate looking to raise money to fund a wind turbine to power one of its industrial units, as an example. So that is the fastest growing area of the fixed income market at the moment, green bonds, and it's a growing part of our portfolios. Within alternatives, this is where we can align with the UN SDGs in a quite strong way, because this is where we can be very targeted in the exposure that we have, and looking at some of the more illiquid areas of the market. So this is where we have big investments in areas such as renewable energy. This has formed the bulk of our alternatives exposure for the last few years. But during that period, the yields that you've been getting in that space have been coming down. So it's becoming more challenging to find good investment opportunities at this time. So we are looking to diversify away, and we're looking at areas such as social housing and sort of broader healthcare property units. So that's something that has a clear alignment with the UN SDGs. But also provides diversifying benefits for the portfolio in terms of being yield producers. Moving on to next slide, please, Josh. So I mentioned that I'd talk about some of the misperceptions in the market. So these are the four big ones for us, and these are the ones that we come up against when we're presenting our strategies to clients. The first and second are quite linked. So the belief that your performance will be sacrificed and you'll have to take more risk to invest in this way. Theoretically, this is driven by the outset of ethical investing. And traditionally, if you do reduce your investment universe, you are reducing your opportunity set to outperform, and therefore you should, over long term, have lower returns and have higher risk. So if your focus solely is on excluding areas of the market, that is where this myth is developed. But what we see now is this focus on improvement. So ESG investing is that process of constant improvement, and investing in those companies that are looking to transition their business models to become more sustainable companies, and as a result have greater growth opportunities. That is compensating for the exclusions on the other side. In terms of cost, I'll talk about passive investing, which has allowed us to manage our costs. And then in terms of tangible impact, I've got a few stats looking at what is the impact of investing in this way. So next slide, please, Josh. So firstly, on performance, this is something that we looked at prior to launch, and something that gave us confidence to launch the strategies 5 years ago. This is showing you the performance of a number of equity indices, and then comparing that performance against a sustainably screened version of that index. So we're taking the SRI indices. So these are at the darker green end of the ESG spectrum. So this is looking at the top 25% of companies within a parent index based on an analysis of their ESG credentials. It also has that exclusion of areas such as tobacco and weapons. So it's a meaningfully screened index. And you can see that performance, this goes back, it's various inception dates, just to flag. But for the US, goes back to 2007. But you can see that for all of the regions, except for emerging markets at this time, that the sustainably screened indices have had a better annualized return over the last decade plus. And if you look at this on a risk-adjusted basis, so if you look at the Sharpe ratios for these performance points, it stands up as well. So it's not just a case of taking more risk to achieve that return. You have seen a consistent outperformance of sustainably screened indices over the last few years. Next slide, please. And that's something that has played out for us internally. So this is showing you the performance of our sustainable balance strategy against our balanced core strategy. And you can see that the strategies have performed in a very similar way with very similar risk profiles. So we're showing you that the maximum drawdowns stats here, and that's all from Q1 last year. And you can see there's almost a perfect alignment. So during the COVID market falls, our balanced core strategy fell 20% and our balanced sustainable strategy fell 19.9%, or the other way around, yeah. So almost a perfect alignment, which is a tick in the box for the risk management. And then you can see the performance figures over this time period being very similar as well. So we haven't had to compromise on performance and risk, and this is sort of showing us that you can run a multi-asset portfolio in a sustainable way without compromise. Next slide, please, Josh. So, and we believe this is likely to continue, and there are a number of factors that are going to drive this. On the environment side, I think we've seen a huge shift in terms of policy over the last 12 months. So the big stories have been China committing to carbon neutrality by 2060. We've finally seen in Europe, we've seen the Green Deal and a commitment to climate neutrality by 2050. And then in the US, the Biden deal, which is starting to be formulated, has a big clean energy is a key part of that manifesto. So there have been huge shifts in the superpowers of the world, and that is going to create investment opportunities, and it's going to continue to drive this sustainable movement. And we are seeing that throughout the industry with money continuing to move into sustainable mandates. On the social side, you don't have to look very far to see shifts in corporates in terms of the social license to operate. I've flagged Coca-Cola here, which you wouldn't sort of hold up as a sustainable leader, but actually they've realized that they need to transition their business model to become more sustainable in order to survive. And therefore they've become leaders in plastic recycling. And you're seeing this throughout all industries at the moment, and again will be a driver of outperformance going forward. And then on the governance side, you don't have to look very far through history to see examples of where poor corporate governance have resulted in bad outcomes for investors. Wirecard obviously being the most recent example of that. Next slide, please. So on the cost point, we've mentioned a few times that we're style agnostic and instrument agnostic when it comes to how we implement the strategies, and this is showing you the breakdown of our equity portion of our balanced sustainable strategy. And you can see that passive instruments form a meaningful part of that exposure, and this is key for us as top-down investors. It's an efficient way of implementing views and gaining access to markets, and allows us to manage the overall cost of the portfolios in a way that they are now aligned with our core offering. So there is no increased cost to invest in a sustainable way, and a big part of that has been driven by the development of the passive industry. So for us, again, I mentioned that we're using the SRI end of the spectrum. There is a huge spectrum between that, and again, so there are a number of ESG indices that have fairly minimal ESG screening, but have a lot lower cost as a result. So I guess you have to be careful in terms of understanding what you're getting with your passive instruments, and also you want to balance sort of the risk, the benefits of cost versus the level of screening that you're getting. And we feel that the SRI indices are a bit of a sweet spot for us, with meaningful screening at a reasonable cost, to the point where we're now aligned in terms of cost. Next slide, please. And what's the actual impact of investing in one of these sustainably screened indices? Well, this is a simple measure of the carbon footprint of $1 million invested in an SRI index versus a broad world equity index. And you can see there's a dramatic reduction. It's important to flag this is scope 1 and 2. So it's looking at the direct operations of a corporate. It's not looking at the indirect emissions of the products that they're selling. But actually, if you look at the Scope 3 analysis, it's not the easiest thing to do, given the disclosures at the moment aren't quite at the level that we need to fully sort of report on this. But they are showing a dramatic reduction also, not quite as much as 75%, but there is a meaningful reduction in your carbon footprint by investing in a sustainable way. Next slide, please, Josh. So quickly, just looking at time, I'll run through a few of the holdings that we think are interesting. So government bonds has been a particularly challenging space for us, because on the one hand, we don't want to be, so one of the primary UN Sustainable Goals, the number one UN Sustainable Development Goal is to end poverty. And with that in mind, we don't want to be increasing the funding costs of some of these emerging governments, emerging countries, by divesting in them and forcing their cost of funding to increase. So but at the same time, we want to make sure that we are having a meaningful screen introduced so that we're incentivizing better behavior. And we've fallen on this approach for our EMD exposure. This is a strategy run by DPAM, a Belgian company, and their screening will focus on democratic high performers. So you're looking to incentivize better democracies globally, without having a sort of a blanket ban on countries because of their resource uses, for example. So this excludes some of the authoritarian states, but allows us to have exposure to emerging market debt, and support those countries that are leading when it comes to democratic freedoms. Next slide, please. Quickly in my last 2 minutes. So this is an example of one of our renewable infrastructure assets. This is the Renewable Infrastructure Group. So we invested back in 2016, and renewable infrastructure has been a fantastic investment for us. We've seen the cost of production collapsing to the point where it's now competitive against traditional forms of energy production, and without the need for subsidies. What this has created, though, is a yield compression as more money has come into the space, and therefore looking ahead, the return expectations have come down meaningfully. So we are looking to diversify, but at the same time, our underlying investments are also doing the same. And you can see that they have introduced an investment in a battery storage unit. So this is sort of a sign of direction of travel, that our company's underlying investments are going to be looking at new areas that will have both better return prospects, given it's relatively new technology, but also it will help society, given the fact that it will help smooth the grid, and you'll be able to have greater reliance on renewable energy going forward. And then final slide, please, Josh, before concluding. This is just an example of one of our thematic equity holdings. This is Robecosam Smart Materials Fund. So this is investing in circular economies, improved efficiency, and next generation materials. Why do we like this? Well, ESG investing often in terms of style leads you to the quality growth area of the market, whereas this is giving us some cyclicality in the portfolio. So we have the added benefit of investing in areas of market that are improving efficiency and reducing the sort of waste production in society. But at the same time, it's giving us some of that cyclical exposure, which is important when we're looking to perform in line with our core offering at a time when reflation might be coming through. But that is another discussion for another day. Next slide, please. So finally, just to conclude, we believe this is a very exciting time. Some are saying this is a once in a generation opportunity to invest in energy transition globally, but also just a broader sustainable opportunity. And we truly believe that sustainable investing can make you money without compromising on the key principles of returns, risk, and cost. And at the same time, you are having a tangible positive impact by supporting change. So with that 1 minute over, I'll pause and open up to questions. Thank you for your time.
Ben, thank you very much. That's a really interesting run through. So you'll be pleased to hear that we've had a lot of questions. I've got a note of them here. And for those asking, first of all, thank you very much. If we don't get through them all now, which is highly unlikely, we will make some time after the call, and Ben and I will put our heads together and get back to you with some answers via Jane or Jess or Beth or Josh. But Ben, I thought I'm not going to read these out in any particular order, but the ones that I think are most not most interesting, but I think the ones that are most relevant and wide-ranging. So the first one is all about the screening of fossil fuels and extractive industries. That's not something that's been kind of focused on in our exclusions. Do you want to elaborate on that? Because I know we talk about this a lot in the team and with clients. So why do we do it this way?
Yeah, that's a very good question and a key topic for us at the moment. So there are two approaches that you can take within the sustainable space: divestment, where you divest all your investments within fossil fuels, or you take the sort of best-in-class approach, where you're looking to support those corporates that are leading the way when it comes to energy transition. So supporting those best-in-class companies while removing the sort of worst culprits. I think this is a key area in terms of for us, the journey of sustainable investing and the constant improvement. So at the outset, we very much focused on a best-in-class approach with fairly minimal. So looking to support those companies that were the leaders in terms of investment in renewables and were clearly transitioning their business models. But actually, we're starting to introduce sort of a stricter approach now, and actually we're being more aggressive with our screening out of fossil fuels. This is both being led by sort of internal discussion, but also externally, you're seeing a lot of the passive instruments starting to divest from fossil fuels, and the UBS ETFs are a good example of that. They recently removed all meaningful exposure to fossil fuels from their ETFs. So there's a bit of a push and pull going on, but the direction of travel is clear. We have a meaningfully less in fossil fuels. We're looking to continually reduce it, but we want to support those companies that are transitioning and are leading that investment in renewables.
Thank you. No, that's helpful. So another one is about greenwashing. It's if you are advising an investor to overcome the problems with greenwashing, what suggestions would you have? I suspect your answer will focus around just doing the research as we do and a lot of due diligence, but maybe you'd like to put your own spin on that.
Yeah, I think that the key issue of greenwashing is that misunderstanding of where you sit on the spectrum. So I'll sort of take you back to that process slide where we broke it down into 3 simple pillars, and that sort of spectrum along the green curve. I think that the key is to understand where you sit on that curve. So greenwashing has come about where investors have felt that they had meaningful integration of ESG analysis and meaningful exposure to impact, but actually all they were exposed to were simple exclusions. So I think, there's no getting away from just doing the research and understanding what you're investing in, because there is a broad spectrum when it comes to ESG strategies. I think we'll see policymakers starting to come. Suresh will talk about this. We'll play a greater role and make it, and we'll have sort of clearer labeling of strategies going forward. But for now, I think it's important to do your research and understand the level of screening that you're introducing.
Okay, thank you. We have 4 more minutes of questions. You'll be pleased to hear. So another good one I thought I'd relay. Do you have any fear of a bubble bursting around ESG investments in the near future?
Yeah, so this is obviously a potential long-term issue with the sustainable movement. As sustainability is priced into markets, there is a risk that it may get overly priced in, and you will start to see sort of expected returns get to a level where they become it becomes a bit of a bubble risk. But I think for us, it still feels like we're a long way away from that at the moment. And there are ways of mitigating against that for us, particularly as multi-asset investors. We are constantly sort of looking to maneuver the portfolio to optimize the risk return profile. So I guess, as with any investment, there is, or in any part of the market, there is risk of bubbles developing. It feels like we're still very early in this journey. We're only just starting to see big policies being introduced to support the sustainable push, and the amount of money that's going to be required to meet our goals and sort of hit those UN SDG targets by 2030 is absolutely huge. So yes, it's a risk. It's something that we'll monitor, as we do with all asset pricing, and that we will be able to sort of maneuver the portfolio to try and avoid that as best we can. That example of the smart materials strategy is a good one. So that's us looking for ways of investing in cyclical areas of the market without having to compromise on the sustainability of that investment. So we're not just investing in sort of the best of the best, the broad global growth ESG winners. We are looking at other areas such as the Alquity Asia Fund and smart materials.
Okay. One has just popped in, which I thought I'm quite keen to hear your views on. Do you feel that popular ESG investments have become overvalued due to large inflows recently? And how do we account for this in portfolios? And I mentioned, the reason I wanted to read that one out, Ben, is because, as you know, we've got live discussions right now about a few holdings which have done particularly well. Your thoughts on rebalancing and the appropriate kind of portfolio construction for lots of these. How would you tackle that from an on the ground perspective?
Yeah, it's a very good point, and there will become a premium. There has been an ESG premium sort of developing in the market. You only have to look at what's happened in the oil market to see sort of the negative impacts of the sustainable flows that we're seeing. But for us, it's as I mentioned before, it's about sort of monitoring those risks. So the big US ESG tech winners have clearly had an incredible run. But sort of the growth, the quality growth style in general has had an incredible run over the last decade. So for us, it's about potentially looking to rotate some of those profits and look at other areas of the market that have been slightly more unloved and are trading at sort of better, more attractive valuations, looking at forward expected returns. So trades we've been doing recently, sort of taking some of our profits in our US and global names and looking at areas such as the UK, where yes, we've seen money moving into ESG strategies, but the UK generally remains very unloved. So on a relative sense, it could be a way for us to potentially play that value trade in a sustainable way. So it's definitely a lot harder to if value became the driving style of the next few years, it would be harder for us as sustainable investors. But there are opportunities there that we believe we can use to manage it.
Brilliant, Ben. Thank you very much. We've run out of time for questions. There were some questions relating to ESG returns, which I think you covered, though I didn't ask you that one, and one relating to renewable infrastructure. But there are plenty more which we haven't addressed. And I promise everyone on the call, I haven't just picked the easier ones. We will come back to you once the call is over with a few lines on each of those. Now it's time to move on. So Suresh, if you're there still, I'm going to hand over to you. So as Jane mentioned, Suresh is the co-founder of Alquity. They have a product which we use. You probably saw that in Ben's slide, looking at the balanced sustainable fund. It's near the bottom, about 3.5% weighting for us at the moment. But with that, I'll hand over.
Thank you very much, Graham, and thank you everyone for the introduction today and for allowing me to come and share with you the Alquity story and how we do ESG investing. I'm just going to share my screen, Josh, is that okay? And hopefully we'll get a to the front of the presentation. Can everybody see my screen?
Yes, I can see it.
Great, thank you, Graham. Let me just introduce myself. As Graham said, I'm one of the co-founders of Alquity. Been with the business since we launched in 2010. And my main roles, several different hats. One's around client management. I look after our clients based in Asia, the Middle East, and parts of the UK, including Handelsbanken, luckily. I also am the head of ESG and impact reporting for the business, working closely with the investment team on how we develop our investment process, but also how we communicate that to our clients and other investors. And finally, I'm the lead with the Alquity Transforming Lives Foundation, which I'll explain to you in a second and how that fits in with our business as a whole. Today, I just want to share with you a little bit about Alquity and then kind of go into the ESG investing in a bit more detail to show you how it works from a kind of nuts and bolts perspective. But what gives us the license to do that? We launched the business back in 2010. And we're one of the few pure play ESG asset managers in the marketplace. We're not transitioning from being a different type of asset manager into ESG. ESG is what we've always done, and it's what we will always do. And we've believed in it from day one, and that makes a big difference in terms of how we approach the investment process. That's been recognized. You see on the right here some of the kind of awards and recognition we've achieved. The United Nations Principles for Responsible Investment grade our process A+ across all three key aspects. There's something called the label ISR, which is issued by the French Finance Ministry. We see this as the kind of gold standard in ESG certification. This involves a 2.5-day on-site audit of our process, of our team, of every single stock in our portfolios. And we've received that certification since 2018 for every single fund. And then recent awards we've won through kind of finance journals, etc. So it's a process that we're proud of. We've honed over the years. It's something we've learned to do. It's not something we've switched on overnight. And really, to kind of explain our ESG process, you really need to understand what Alquity is all about, the actual business itself and how we created the business. The word Alquity is a combination of two words. It's a combination of the word altruism in terms of selfless giving and equity. Equity in terms of stocks and shares, but also equity in terms of fairness. And this is at the heart of what we do at Alquity. And the heart of Alquity is what we call our virtuous circle. The circle consists of three aspects: attractive returns. Any fund manager, for people like Handelsbanken, Graham and Ben to invest with us, we've got to give them the opportunity to deliver returns for their clients. And we believe we do that, and we've believed since we launched the business that this is done through ESG integration into the investment process. And I'll explain how we do that. We focus on emerging markets, so this is active ESG integration. As a consequence, the portfolios we create that are responsible, they consist of companies who are looking for long-term inclusive growth. And these are not just companies focused in, say, renewables or kind of sustainable sectors. This is companies across a range of sectors, the kind of real world, particularly in emerging markets where, you're still looking at growth that has to come from urbanization, consumption, things like that. And finally, we turn that ESG lens back on ourselves. There's one thing asking our holdings to behave in a certain way, but what do we as asset managers do? And we firmly believe that wherever you're born in the world, you should have an equal opportunity. And we see this starkly, the inequality. We've seen COVID-19, for example, bring out the inequality in the world. Well, we've been challenging that since the beginning. So 10% of all our revenues go to transforming lives projects on the ground where we invest. Could be Africa, could be Latin America, could be Asia. And these help in a couple of ways. Firstly, we clearly want to help some of the people on the lowest rung of the economic ladder get this first step onto that economic ladder, start contributing to the sustainable growth of that economy. But what they do as well is they give us opportunities for our investment team to really understand what's going on in particular economies, particularly when you're in the frontier markets. And that actually helps us with our research agenda and actually closes the circle in helping us deliver better returns for our investors. I'll explain a bit more of that in a second. So going into our investment process, in a bit more detail, let me just explain how we integrate environmental, social, and governance into our process. The first key aspect for us is materiality. ESG, I think both Ben and Graham have talked about the kind of wide range, and people often talk about greenwashing and companies just, everything is fantastic, it's wonderful, it's kind of a gloss placed over them. What we care about is those behaviors in those companies that are material to the future performance of that business. This chart, and we're on a business school presentation, so it's a 4-box grid. I apologize for that, but it's probably the best chart I've seen in all my time working in ESG. It's a piece of work done by the Harvard Business School. It compares companies on the bottom axis who focus primarily on immaterial ESG issues versus companies who focus on material ESG. So to give you an example of what I mean by material and immaterial, if you're a bank, your carbon emissions is pretty immaterial to your future performance. You know, I care more about your responsible lending policy or your whistleblowing or your anti-corruption policy. Whereas if you're an extractive, I really care about your greenhouse gas emissions, because that has a material impact on your future performance and your regulatory situation. So that's the difference between immaterial and material. And what this graph chart shows is companies that focus on material issues outperform. And this is a meta study done over kind of 30 odd years or so. The alpha is around 6%. And what it also shows is companies that don't do anything related to ESG underperform. And quite interestingly, people who try to do everything, which can be termed as greenwash and try and show that they're doing everything under the sun, do better, because some of those things are material. But ultimately, it's not that significant. So where we're concerned as investors is in that material aspect. So how do we incorporate materiality into our investment process? Well, our investment process includes ESG at all stages. There's the first stage, which is filtering, where we're actually going from that universe to understand which is that core universe which we're going to pick our companies from. Then we actually look at the valuation. How do we quantify whether this stock is worth investing in? What's the potential upside to investing in that business? And then finally, once we own that company, how do we manage that company? How would you look at engaging with them over time? And how do we kind of ensure that they continue on that ESG journey? And what I'll do is I'll explain each aspect in detail. So in the first aspect, the key area for us from an ESG perspective is what we would call the red flags. And this is the minimum acceptable criteria for us. So firstly, we do have exclusions. I know somebody asked questions around what exclusions are out there. We exclude these areas, so we include fossil fuels in our exclusions. But we do have, for example, we do have extractives. And this is often where exclusions and that decision-making can be quite a difficult balance to maintain. You know, do you exclude copper mining? You could say it's a very high waste producing, carbon emission producing industry, but how do you have electrification if you don't have copper? So a bit like what Ben and Graham mentioned, you look for the best in class. So while we would not exclude something like copper mining or extractive, we do believe areas such as gas, oil exploration and production, we will exclude. Coal mining is another area. In addition to exclusions, we also have what we call red flags. These are norms, minimum standards we expect from companies. If they don't meet any one of these red flags, they are excluded from our portfolios. To start with, some are kind of sector specific, others are kind of across industries. So for example, under environmental, if you're a beverage manufacturer or a high water use company and you are not disclosing your water usage, we will not invest with you. We feel it's a material aspect of your business, and if you're not prepared to measure it and report it, you're probably not prepared to do anything about it, in which case we don't want to be part of that business. So we'll exclude companies in certain sectors for certain behaviors. And if a company has an ongoing controversy, unresolved scandals, we won't invest. We won't kind of say, well, you know, it happened in the past. We'll give them a clean slate clean slate going forward. We'll look at it. If it's still ongoing, if the management haven't made any changes, we will not invest. So these are our kind of red flags and minimum standards. Once companies go through that filter and have passed these red flags, we then go through our own proprietary rating systems. Somebody asked a question around indices and the kind of use of ratings from providers. We believe, particularly in emerging markets, and we know from experience that many of the indices, many of the ratings providers don't have the level of coverage we need. We tend to focus on small and mid-cap companies where the real opportunity, growth opportunity often is in emerging markets. Many of them don't complete the Sustainalytics ESG report that's sent to them. So they're not covered. So we don't use in our emerging market strategies any external agency. We do the work ourselves. Our investment team do the work themselves. We rate companies A, B, or C, depending on their level of ESG behavior. A's being the best in class, C's being companies that meet our minimum standards, but have areas for improvement. And we split this between high risk and low risk industries. High risk including things like extractives, livestock farming, things like that, and lower risk being areas such as retail or banking. A rated companies, we are able to adjust the valuation in our discounted cash flows by adjusting the risk premium. So reducing the equity risk premium, thereby over the long term, increasing the valuation in our forecast for that business. Therefore, adding a direct connection between our ESG analysis and the valuation. For C-rated stock, we can actually do the converse and actually increase the equity risk premium, thereby showing that that company has more to do, in our view, to achieve those valuations that we will justify it as an investment. We also add in equity risk premiums for companies that are exposed to the carbon neutral economy transition. So automobile manufacturers, cement producers, things like that. So that's how we do our detailed ESG analysis. And obviously the two things, ESG and financial analysis, come together. ESG is necessary, but not sufficient. We don't just invest in a company because its ESG is great. It's got to have a business case. It's got to have a good investment case as well. Let me give you an example of a company that kind of shows that process in motion. Amrutanjan is a paint bar manufacturer in India. It's a smallish company. It's around $233 million market cap, not covered by any of the kind of ratings providers. We've picked this company up a couple of years ago, talking to the management. Great brand, very much at the lower end of the economic spectrum. People who are just looking for some. It's the equivalent of Vicks. The inhalant that we have in the UK, are very well known, and they're moving into new areas such as sanitary napkins, etc., but at a much lower price point than competitors such as Johnson & Johnson, Procter & Gamble, etc. And as a consequence, they're contributing to SDG 3 in terms of good health and well-being. Our ESG analysis shows they meet our minimum standards. You can see here the water usage is tracked. They go for zero discharge, wastewater is recycled. They're looking at the moving from plastic to glass in their bottles, etc. Health and safety, good health and safety policies in place, certified in terms of ISO standards, and they've got independence at the governance and the management level. There's still stuff to go. They don't produce a sustainability report, which is something we will engage with them on and see. And we've rated them C. And we expect over the years, as we work with this company, to go from C to B to A. And we will actually see a re-rating in some of our performance as a consequence of that. The financial analysis, strong balance sheet, cash flow generating, good business from that aspect. And so we're able to come up with a valuation based bull and bear. So this is a kind of implementation of our ESG process at a stock level. This is how we pick a stock. Now, often when we're picking stocks, once we've got them in the portfolio, we engage with them. Often our investment team are engaging with companies before we even invest in them. And I'll give you an example of that in terms of our engagement and ownership process. Here's another actually Indian stock. It's a company called V-Mart, based in northern India. It tends to be in the secondary towns, where in India, secondary town will still have a population of kind of 5 million people. And what they do is they offer clothing at kind of affordable prices, just above the price of a market stall. So it's for that kind of growing population that want to have a better shopping experience. They want to have a changing room, air conditioning, use their credit card, have a refund policy, but it's not the equivalent of Harrods, shall we say, or Selfridges. So this business, we met them in 2014, conducted our ESG analysis on them. And one of the areas we investigated was the supply chain. Supply chain in retail is really critical. Clearly, there's been issues. Take the Rana Plaza disaster in Bangladesh in 2013, where several thousand people died because of poor health and safety conditions within their working and employment of child labor, for example. This company told us, well, our suppliers self-certify that they don't have child labor, that they've got great health and safety. And we said, well, it's great they do that, but it's not really acceptable for our perspective, because we see that as a significant risk as potential investors. You really need to be doing audits. So we kind of told them about our thoughts. A year or so later, we met them again, and fantastic, they were actually doing audits. We had another detailed conversation with them about their supply chain, and what we learned was their audits, they'd ring up the supplier 2 weeks before and say, in a couple of weeks, our auditor's coming in, just to let you know. As you can imagine, if this supplier was not completely doing things legitimately, things would change between the day the audit happened and the day before. So we introduced them to IKEA, and they've got fantastic supply chain management. And next time we met them, they were actually doing mystery audits. They were going in and doing supplier workshops on, use of wastewater, things like that. So I'd really transformed their supply chain management. We invested in this company around kind of late 2016, and it's performed fantastically well. But it was a C when we invested. It's now a B, and we've seen that kind of shift in their behavior has led to not just a great performance for the company, but also better performance and better experience for their employees, the communities, and the suppliers they work with. So when we're engaging with companies, we engage across the portfolio. And about 2 years ago, we decided that actually these stories are great, but how does an investor across all our funds, across all our portfolios, get a sense of what we're doing? And we wanted to track our engagement. So we developed what we call our key progress indicators. Now, these are a set of aspirational objectives that we want every single company that we own to meet. And many of these are around disclosure. As you can imagine, in emerging markets, the regulatory environment isn't as robust or as strong as, say, maybe in developed markets. So we want the company to take much more of an onus, disclose their emissions. Now, clearly, if it's an extractive, this is a red flag. If it's a bank, yeah, we're not going to be too upset if you don't, but we'd like you to, because it sets the standard. And so we're working with all our companies across all these environmental, social, and governance aspects. And of course, once you've measured something, you can do something about it. So for example, on the social, if a company's got health and safety policy, we can then start asking them about their lost time injury rates. So we can say, where's that moving? What are you doing to make the environment in which your employees are working safer? So that's how we track, and we can report this to our clients annually. Engagement does take time. It's not something that happens overnight. So you can see the progress on different aspects of whether it's health and safety policy or greenhouse gas emission reporting or water usage reporting. Clearly, some will be at 100%. We've got whistleblowing. Every one of our companies reports whistleblowing, has a whistleblowing policy. It didn't before. Other areas, there's still room for improvement. But equal opportunities, for example, but where it gives us an idea and gives our investors a clear idea of progress. We engage on a variety of topics. Here are just a few examples of the things we engage with our companies on. Xtep is a Chinese sportswear manufacturer, so inclusion of greenhouse gas data in their ESG reporting. And these are things that companies have actually come back to us and said, Alquity, we're doing this because you asked us to. This is direct results of our engagement. And we continue to engage with a whole range of companies on a variety of topics, whether that's disclosure or whether it's actually, how they behave in respect of, for example, Alicorp, a Peruvian retailer around deforestation and palm oil and soya supply into their products. Some people, I think we mentioned earlier, the tech companies. We did a recent report on tech companies, and a lot of sustainability funds tend to be full of tech companies because they have huge revenues and often relatively low carbon emissions in relation to them. In fact, the industry is one of the biggest emitters of carbon. So 3% of global emissions are produced by the internet, by modern computing, and that's more than the aviation industry. So this is an issue that actually affects the internet age as much as any other. And so if you take China's data industry, it produces or uses the same amount of electricity as the whole of Thailand. Not only electricity, water as well. So while a lot of sustainable stocks will tend to be focused around some of these internet gaming stocks like Tencent or Alibaba, etc., there is a significant environmental issue associated with these companies as well. We report the carbon footprint of our portfolios, whether that's waste, water, carbon. You'll notice our carbon numbers aren't significantly lower than the index. One of the things I mentioned earlier is that we kind of have to make that decision between high-risk industries, extractive cement producers, and the impact it has on the economy as much as our wish to exclude them. So one of the areas we invest in is cement. In India, cement is a major requirement for people to help them with sanitation, to stop the kind of issues around disease, around housing. So having suitable housing rather than living in housing built of tenement or rubbish materials, etc. However, that produces large amounts of carbon, the cement industry. So we only select the best performing, the best carbon cement companies in terms of their ESG. This takes a lot more work from us, but we're confident that this is the right decision. Like the example of copper and electrification, you've got to find those big and best companies rather than just kind of saying this is not something I will invest in going forward. It's a balancing act. Thirdly, and finally, in terms of our responsibility, I firmly believe the way you allocate capital shapes society. So the whole purpose around me forming Alquity and being part of the group that runs this business is we want to create a world that is more sustainable. We want to create a world that is fairer for all people. And so we donate 10% of our revenues to projects where we invest. Those could be projects in terms of skill provision. It could be projects in terms of helping small businesses, training, education, or it could be microfinance. It helps our impact in terms of some of the SDGs. We've donated over $2 million. We've transformed something like 60,000 lives. Here's some examples of some of the organizations we've worked with across the globe. Across Africa, Latin America, and India. I'll just like to finish with one of the examples, Fool, which is one of my favorite examples of just a fantastic organization. Fool, the picture on the left, the guy in the middle is a guy called Ankit Agrawal, and he spotted an opportunity a few years ago. Basically, in India, when people go to the temples, they take flowers. It's a way of worshipping, and they take fresh flowers every day. The problem with the fresh flowers is the day after. The temples don't know what to do with them, and what they would typically do is throw them into the rivers, into the waterways. That would cause issues. The pesticides on the flowers would cause issues in terms of polluting the rivers. It would block sewer systems, etc. And Ankit thought, well, let me see if I can do something. So he took the flowers from a temple and actually, using the petals, converted them into incense sticks. Those incense sticks, he then went back the following week to the temple to sell to the temple goers for their worship. So this is a fantastic example of environmental recycling. He then was looking at employment and realized that actually, there were people out there, the untouchables, the lower castes, who were only getting employment in areas such as, cleaning toilets, etc., and wanted dignified employment. So he now employs women from some of the lowest areas of society to, once the flowers are collected, to convert them into incense sticks. They have a whole range of products now. They even have created a leather type product made out of flowers. So great organization we support. We're helping them grow from 200 employees to 5,000. And in addition to that, our investment team, when they last visited India, which was now kind of 18 months, 2 years ago now, were able to do a focus group with the employees. They were able to ask them about products like Amaranth and Jam. They were able to ask them, do you go shopping at V-Mart? How do you use your credit card? Do you use a mobile phone? And this informs our research agenda so that when we're looking for companies, we can identify those potential future success stories. So in summary, this is the Alquity approach. We integrate ESG into our process. We engage with companies and we report on each aspect of what we do when those companies are in our portfolios. And finally, we take that responsibility to do something for society ourselves through our Transforming Lives programs. So that's a quick overview from me. Thank you. Graham, I'll hand over to you to see if there's any questions.
Yes, thank you, Suresh. That's fascinating. Thank you so much for running us through that. We've got minimal time for questions, but we have got a few, and I'm sure if you're happy, the ones we can't cover, you'll be happy to maybe drop some one-liners back to the staff. Okay, great. Well, in brief then, would you say the availability, integrity, and credibility of data is a major concern?
I would agree. I think so. I think it depends. We took the decision in the emerging markets that we would only trust our own data. So the data we were able to acquire. Clearly, there are bodies out there that can provide good information. We work with a lot of initiatives out there that are doing things much more at a sector level. I think it's when people trying to provide information globally that they take shortcuts, or there's not enough the depth of information, shall I say, rather it's kind of 1 inch deep and a mile wide, rather than really a mile deep and an inch wide. So we work with organizations, for example, the FAIR initiative, which focuses just on the meat industry, the protein production industry, and do very detailed analysis. And that's fantastic because that really helps us in supporting our work. But I'd say in general, it's sketchy.
Okay, no, that's helpful. Related to that, actually, another question: do you make your ratings available to investors, and do you make them publicly available?
Yeah, we make them available to our investors. So all our stocks, every single stock, before it goes into a portfolio, has to have a rating. We produce stock notes for each stock, so our clients, our investors, can see those as they wish. We produce an annual impact report where we talk about the entire portfolios, we talk about the KPIs and all the ratings. So all publicly available. If anybody wants any of an example of a stock note, then just drop me a note and I'm more than happy to share them with you. Those stock notes are working documents, so they're not kind of formatted and made to great kind of brochures. They are working live documents that our investment team are using on a daily basis to assess and make investments.
Okay, thank you. Very generous of you. I saw a question here which stood out. I thought was interesting. To what extent would you consider ESG factors as a substitute for a sustainable business strategy?
ESG factors as a substitute for a sustainable business strategy. As I said earlier, ESG is necessary but not sufficient. You need ESG to give you an idea of the quality of management. We're launching some new funds, a global fund, and one of the things we're looking at there specifically is whether the sustainability focus of a company overrides our need for ESG. And what we're looking at there is it has to still meet our minimums. It's got to meet a minimum standard, but actually we may allow a little bit more flexibility for companies that have a sustainable focus. If you are doing something that's just fantastic and you just need support, and many of these companies are kind of in the growth rate, they're growing, they're small, they're growing quickly, and some of these ESG issues are just a case of not having the time or the management attention, rather than any great desire to do anything bad. So we try and give them a little bit more scope. And you see from our ratings, the reason we have C, B, and A is because of that. We see companies that are doing well but could improve. And it's about supporting them on that journey rather than kind of penalizing them for where they are just today.
Brilliant. That's really helpful. Thank you so much. There's plenty others, which we have not got time for right now. But just finally for me, congratulations on your big new investor. That was great news to hear recently. And I think with that, we'll hand over back to Jane.
Thank you very much for such an interesting and insightful presentation, Graham, Ben, and Suresh. So I'd like to also thank everyone here today, especially, obviously, again, repeat to our three speakers, Graham, Ben, and Suresh. So just let you know that the conference is going to run over the next for the next 2 days. So you can register if you haven't done that for now. But tomorrow we will hear from some of our alumni, see what they're going, what they're doing on this particular topic.
That was probably the best ESG presentation, coordinated ESG presentation, the clearest I've ever been to. So I really wanted to thank our presenters, and the discussion, absolutely fantastic. Jane will know I don't usually interject in these sessions, and I'm just absolutely delighted. It was great, and so thank you so much. Sorry, I'm being overly enthusiastic, but it was really fantastic, and I wanted to thank
your area.
And since it's my area, I wanted to thank all three. And it's really unusual to see when we have these kind of sessions. It's amazing to see that the three presenters coordinated to work together. Now, everything that's gone into this has just been absolutely fantastic, and you've set an amazing bar for the rest of the conferences. I really, really appreciate it. So I'll sign off, but thank you so much. Jane, back to you.
Thank you, David.
Thank you, David.
Yeah, well, I suppose all the audience over here would share your view. It is a fascinating and very interesting, insightful presentation, and I'm sure will offer lots of, incentive for students over here to continue on this journey. Continue develop and in the research in ESG and sustainable finance. So yeah, I'm so glad to hear that many of you are interested in this area. This is obviously of great concern for the next decades onwards, right? So thank you again, everyone. Josh, shall I hand over to you? Do you want to say something to close the event for today?
All I'll say is a big thank you to Graham, Ben, and Suresh for giving their time to us today. If you're not aware, we are running these sessions tomorrow and the day after as well. You should have received the Zoom links in your joining instructions email that you received yesterday. If you haven't, please reach out to one of the alumni team or email us. And we hope to see as many of you as possible tomorrow as well. Thank you very much.